Companies do borrow money in order to expand and grow. In fact, there is a common understanding that you can never be rich unless you borrow. Now, why do companies borrow money? They borrow money in order to expand and increase their operations, probably by hiring more equipment, buying more equipment, expanding their production levels, hiring more staff, and all that is supposed to increase the profitability of the company. And it is a good thing. That's how most companies have grown to what they are today. The problem with borrowed money is the misconception that it brings with around to payment of taxes. Most businesses think that every cash outflow, money leaving your organization, is an expense that should be claimed when preparing the taxable profits. And they also think that every other income or money flowing into your firm is an income and that you should pay taxes for. But ironically, businesses don't pay taxes on the income they receive or the money they receive in form of loan proceeds. But in a twist, when they are repaying for these loans, they want to consider 100% the money repaid to the financier, to the lender, as a business expense. This accounting mistake has caused many companies to be issued with additional tax assessments by KRA, which results in them paying more taxes, fines, interest, and more penalties. So I want to break down what do we mean by a loan facility? How does a loan work in terms of the loan repayments that we have, in terms of loan repayments, which comprises of two components, the principal amount and number two, the interest amount. What is a loan? A loan, by definition, is borrowed money that the company wishes to use in order to expand their operations, to buy more machines, to do more production, to hire more people, with the main goal of increasing their profitability. A loan, when it is received by a company, comes in two ways: as an asset and also as a liability. A loan is an asset because it is a resource, and that's why the company is going out to look for it. It is a resource that will increase the power, the capacity, and the potential of the company to produce more, to do more, and to increase the quality of their goods and services. But also, it is a liability as a result that it is something that will be paid back to the lender, to the financier. If you hire a car to go to the village, you pay for the hiring fee. Yes, it is an asset to you. It is making you move faster and more comfortably, but it is not your asset. You will have to return it back to the owner at the end of the day. And therefore, in a similar manner, a loan is both an asset and also a liability. So let's discuss where it matters the most, because KRA will not even get bothered how you treat a loan, whether you want to treat it as an asset or as a liability. That's up to you. Those are balance sheet issues. But let's discuss about the income statement matters. How do you treat a loan when you start repaying for it? How do you treat it as an expense? How do you treat it as an income? That's where KRA is concerned. By the way, KRA is mostly concerned with your assets, with your expenses and with your income. It is not so much concerned with your liabilities and your assets. So, loan with reference to expense. Every other month, for the duration of the loan, you will be making monthly repayment. And these monthly repayments, they comprise of two components. Component number one is the principal amount, and the other one is the expense, the interest expense amount. To make it very simple, I will assume that you have borrowed 100,000 and you need to repay this borrowed money at an interest rate of 20%. So at the end of the day, you will pay 20,000 as interest expense. Total amount to be paid, 120,000. Do you want to consider 120,000 as an expense to your business? If you do so, that's okay, but KRA is watching and they will come after you. They will tell you that only 20,000 was supposed to be an expense. The other 100 is money that you had borrowed and you are simply returning it. So if you used 120,000 as your expense when computing for the taxable profit, KRA very quickly, they will disallow the 100,000 as an expense and they will add it back to the taxable profit. They will recompute your taxes again. They will penalize you with fines, interest, and more penalties for not following accounting rules with reference to computing of the taxable profit. So to avoid all these problems with KRA, always ask yourself, what portion of the amount that I'm repaying for the loan is principal amount and what portion is interest amount? Principal amount, they only reduce the amount of the liability that is outstanding in your balance sheet. That is statement of financial position. But the interest amount is what you deduct in the income statement as an expense. So that's what reduces your taxable profit, and that's a good thing. Always maintain proper books of accounts so that if KRA is not very sure how you reacted or how you treated your repayments, you'll be able to produce the loan agreement that you have with the lender, clearly stating the amount that you borrowed and the agreement that you entered into with respect to how much you'll be paying and how much will be comprising principal and how much will be comprising the interest expense. Maintain your bank statements very properly. That shows how much money was going out of your bank account to repay for the loan. Because KRA, when they come for you, you need to be ready to explain to them the nitty-gritties. If this is very complicated for you, ensure to work with a professional tax expert, someone who understands the tax complexities that we have here in Kenya. Because compliance is not a choice. Compliance is a requirement by KRA, by the government of Kenya, if you want your business not only to thrive, not only to survive, but to thrive. Do the right thing.